During the entire crisis, I couldn't sleep peacefully for many years. My fear was not about the numbers, but about the people. Millions could lose their jobs, their homes, and their futures. These simple yet haunting words from Bernanke, former chairman of the Federal Reserve, reveal more than just the concern of an economist. They reflect how he saw the role of a central bank in the 21st century, not merely to manage money, but to safeguard society's trust. The book 21st Century Monetary Policy is not just a dry record of interest rates and balance sheets. It is the story of America navigating through economic earthquakes, where ordinary people felt the impact of decisions made behind closed doors in Washington. As both an insider, a scholar, a policymaker, and a storyteller, Bernanke offers readers a perspective that is both insightful and rare. This book is written by the man who held the wheel of the American economy through the storm, yet tells the story without arrogance or dryness. Instead, page after page shows a humble Bernanke, analyzing with clarity and depth. He does not only recount changes in interest rates or exchange rates. He tells a story of trust, of how decisions made by a few in a single room can affect the lives of hundreds of millions. For readers who love economics and finance, this is a precious work. For policymakers, it is an invaluable reference, and for everyday readers, it is a journey through the milestones of modern economics, told in a voice that is clear, vivid, and full of life. If you find monetary policy as thrilling as an economic thriller, then don't just stop at this summary. Get your copy of 21st Century Monetary Policy by Bernanke and explore the full journey of upheaval, recovery, and sharp insights from someone who understood crisis and recovery better than most. And if you enjoy this way of storytelling, financial, compelling, approachable, and full of emotion, don't forget to subscribe to my YouTube channel, so you won't miss other great books, sharp analyses, and unique perspectives from the world of economics. Part 1, 20th Century Monetary Policy. The story begins in the 1950s, a time when the American economy seemed to run like a smooth, well-oiled machine, full of promise. People believed in the future, they trusted their government, and above all, they trusted in a stable dollar. But behind the bright curtain of the post-war boom, a hidden fire was smoldering, the fire of inflation, quietly creeping into every figure, every report, and every policy, often unnoticed. For over a decade, from 1952 to 1965, the Consumer Price Index rose by only 1.3% per year on average. Economists began to believe that America had entered an era of perfect economic management. But in 1966, a sudden shift arrived. Consumer prices suddenly jumped to 3.5%, a troubling figure for policymakers, and a warning sign that the economic ship might be turning toward dangerous waters. The term Great Inflation began to take shape. And it was no coincidence that this erupted just as America was entering the Vietnam War. At the same time, President Lyndon B. Johnson, Kennedy's successor, launched the ambitious Great Society programs. He believed America was strong enough to fight a war abroad while also funding prosperity at home. Military spending surged, while massive money poured into social welfare. The federal budget swelled like an overinflated balloon, and the labor market overheated. But the bigger danger lay in how people thought about inflation. The Phillips curve, a fresh economic idea imported from the UK, was embraced in Washington as if it were undeniable truth. It suggested that policymakers could trade off between unemployment and inflation. If you wanted more jobs, you had to accept rising prices. And vice versa. The Johnson administration loved this theory. They believed that if unemployment could be kept around 4%, the economy would run at its best, without worrying too much about prices. The Federal Reserve, under Chairman William McChesney Martin, famously nicknamed the man who takes away the punch bowl just as the party gets going, wanted to tighten monetary policy. But the White House fiercely resisted. At one tense meeting at President Johnson's Texas ranch, Martin was scolded directly, "My boys are dying in Vietnam, and you won't print the money." The Fed backed down. From that point, inflation not only rose but seeped into people's expectations. The real danger was no longer just higher prices, but the belief that prices would always rise. Businesses raised prices assuming their competitors would do the same. Workers demanded higher wages, fearing their pay would lose value. And so, a vicious cycle of wages and prices began. It was like an invisible octopus tightening its grip on every vein of the economy. When Richard Nixon took office in 1968, he found himself sitting on an inflation time bomb. Instead of addressing the root cause, he chose a shortcut: price controls. On August 15, 1971, he froze wages and prices for 90 days. At first, people cheered. Meat, gasoline, and milk prices stopped climbing. But soon, the cracks appeared: shortages of meat and consumer goods, empty supermarket shelves, farmers slaughtering livestock rather than selling at a loss. Businesses lobbied for exemptions and found loopholes. And when controls ended, inflation returned with a vengeance, like a beast caged for too long. Now unleashed, then came the oil shock of 1973. OPEC tightened its grip, and oil prices quadrupled. Energy costs soared. Gasoline prices spiked. Transportation costs skyrocketed. And with them, the price of almost everything. The Fed hesitated again. Chairman Arthur Burns, Martin's successor, argued that inflation was caused by cost-push pressures and that monetary policy was not to blame. So the Fed refused to tighten. The 1970s became a lost decade. America was trapped in a new phenomenon: stagflation, high inflation and high unemployment at the same time. A paradox the textbooks had never imagined. Scholars were confused. Citizens were furious. And politicians worried for their seats. By 1979, a tall man with a deep voice, silver hair, and piercing eyes stepped onto the stage: Paul Volcker. Volcker was a true hawk. He believed the only way to kill inflation was through pain. And that's exactly what he did. He pushed short-term interest rates up to 20%, choking the credit markets. Construction nearly came to a standstill. Millions lost their jobs. But the results came: inflation fell, from 13% down to below 4%. Despite relentless criticism, even impeachment threats from Congress, Volcker did not back down. President Reagan reappointed him in 1983, restoring the Fed's credibility as America's foremost inflation fighter. After more than 15 years of battling the inflation serpent, its head was finally cut off, and so the era of the Great Inflation ended, a time marked by the smell of gasoline, by fear, and by uncertainty. The lessons, however, remain: that money is never just about technical charts and equations. It is about people, about choices, and about the cost of hesitation. When Paul Volcker stepped down in 1987, America did not just say farewell to a central banker. It bid farewell to an entire stormy chapter of economic history. But what lay ahead? A calm future, or another brewing storm? And in that quiet transition, a new figure appeared, with deep-set eyes and a habit of speaking in metaphors: Alan Greenspan. This man would lead the American economy for nearly 2 decades, leaving an indelible mark. He was like a captain steering a giant ship through heavy fog, where the compass could point wrong at any moment. In 1987, just months into his tenure, Greenspan faced an unexpected trial by fire: Black Monday. In a single day, the U.S. stock market lost nearly 23% of its value. Nobody understood what was happening. Nobody knew if this was the beginning of another Great Depression. Yet Greenspan, despite being new in office, reacted swiftly. He issued a short but powerful statement: the Federal Reserve will provide liquidity as needed. That single line stopped the panic. It was like an invisible hand reaching into a chaotic crowd, preventing a deadly stampede. From then on, people began to talk about the Greenspan put, the belief that whenever markets were in danger, the Fed would step in like a superhero. Though it was never officially confirmed, this belief naturally seeped into every investment decision, every trader's click on Wall Street. But Greenspan was not only the savior of stock prices. He was deeply concerned about inflation, and about something puzzling he began to notice in the economy. Growth was strong, yet inflation stayed low. A phenomenon the old economic models could not explain. The 1990s were the age of the internet, of globalization, of soaring productivity. Computers replaced paper, data replaced intuition. And in this new landscape, Greenspan was like a conductor leading an orchestra for which no sheet music yet existed. Greenspan did not just look at traditional numbers like inflation or unemployment. He paid attention to unconventional signals, computer sales, software prices, even the pulse of the technology job market. What made Greenspan remarkable was not only his knowledge, but his ability to inspire markets. He often spoke in a language that was vague, layered, almost poetic. Some mocked him, saying listening to Greenspan was like hearing a poet recite a secret code. But that very ambiguity gave him flexibility, allowing him to avoid political pressure. Still, such flexibility had a dark side. He began to be idolized, seen as someone who could bend policy to fight the business cycle itself. The Fed of this era was no longer just a policymaker. It became the guardian of the financial markets. And that was when the dot-com bubble began to form. Internet companies mushroomed after every reign. Anyone with .com at the end of their name could attract millions in investment. Stock prices soared. The Nasdaq, the index representing tech companies, tripled in less than 3 years. In 1996, during a televised speech, Greenspan used the now famous phrase irrational exuberance to warn of overheated markets. But he did not step in aggressively. The Fed did not suddenly raise rates. Monetary policy remained accommodative. And then, the bubble burst. In 2000, technology stocks collapsed. Trillions of dollars in value evaporated within months. But, whether through luck or skill, the economy did not crash completely. The Fed cut rates further to support recovery. Once again, the markets were saved. Yet these repeated rescues planted a dangerous seed in investors' minds, the belief that risk had been neutralized. And when fear of risk disappears, people gamble bigger. A new bubble began to inflate, the housing market. By the late 1990s and early 2000s, loose monetary policy and prolonged low interest rates made borrowing far too easy. Banks began pushing home loans aggressively. Even those with unstable incomes could borrow. Subprime loans, mortgages to borrowers who were almost certain to default, flooded the market. But as long as housing prices kept rising, everyone seemed to benefit. Banks bundled these loans, turned them into securities, and sold them across the global financial system. From Tokyo to Frankfurt, investors poured money into products that looked safe but were in fact debt bombs wrapped in layers of complexity. Greenspan, still in office, recognized some of the risks. But, true to his lifelong belief, he trusted markets to self-correct. He refused to intervene forcefully in housing, convinced that market forces would punish greed on their own. But that punishment never came. And when he left the Fed in 2006, his legacy, an economy of low inflation and stable growth, was already cracking. Just 2 years later, the housing bubble exploded, triggering the global financial crisis of 2008, one of the greatest upheavals in modern history. The crisis itself had not yet arrived in this part of the story. But its shadow was already lurking, hidden in the details of every monetary policy decision at the end of the 20th century. To truly understand the rise and fall of inflation, we must look back at the actions, and sometimes the inaction, of the Federal Reserve during those final years before the new century the late 1990s were often described as the golden spring of the US economy. Unemployment fell to record lows, inflation remained under control, and the stock market, especially technology stocks, boomed. Growth stretched across the entire decade, creating the illusion that the business cycle had finally been tamed. And that a predictable economic era had begun. With sharp intellect and a data-driven intuition, Greenspan ran the Fed as if conducting a jazz performance, flexible, improvisational, never bound by rigid patterns. He looked beyond traditional indicators like the Consumer Price Index. He listened to markets, tracked productivity trends, and closely monitored the attitudes of consumers and investors, yet within this apparent stability, a dangerous seed was quietly taking root: overconfidence. Policymakers began to believe that technology had rewritten the old rules. That soaring productivity would forever keep prices in check. That the Fed could achieve all three goals at once: strong growth, low unemployment, and stable inflation, something once thought to be only a fantasy. The rise of phrases like the new economy only fueled this belief. But as history teaches, confidence so easily turns into illusion. By the end of Greenspan's tenure, cracks were appearing, most visibly in housing, once the bedrock of America's middle-class security, now turning into a playground for speculation. Subprime mortgages spread rapidly. Homes were no longer purchased to live in, but to flip, sold again within months for quick profit. The Fed issued mild warnings, but Greenspan remained firm in his philosophy. The central bank's main duty was to stabilize overall prices, not to manage the value of specific assets like real estate or stocks. That philosophy would later become the center of fierce debate throughout the 21st century. Still, from a technical standpoint, the final years of the 20th century were a remarkable victory for the Federal. From a peak of nearly 14% inflation in 1980, the US had brought it down to under 3%, and kept it stable for more than a decade. And notably, it was done without triggering high unemployment or a prolonged recession. Part of this success came from credibility. After years of painful lessons, the Fed gradually earned the trust of the markets. When the Fed said it would keep inflation low, businesses believed it. And when expectations aligned with reality, prices stayed stable almost on their own, without drastic action. Another achievement was the Fed's independence. Unlike the days when President Johnson could summon the Fed chairman to his ranch and scold him harshly, by the end of the 20th century the Federal Reserve had secured its own standing. Its decisions, though controversial, were recognized as serving the long-term health of the economy, not the short-term interests of an election. This independence was tested during President Bill Clinton's term, when his administration faced pressure to stimulate the economy. Yet the Fed held firm, maintaining a neutral monetary stance despite heavy criticism. Looking back at Part 1, the rise and fall of inflation, we see how a vicious cycle had been decisively broken, from political interference to theoretical confusion, to a mindset that feared unemployment more than runaway prices. All of that had led to nearly 2 decades of great inflation. And only when leaders like Paul Volcker and Alan Greenspan appeared, armed with conviction, knowledge, and political resilience, could the Fed rebuild credibility, regain control of monetary policy, and lay the foundation for an unprecedented era of growth. But as we will see in the chapters ahead, that very success, mixed with overconfidence and tools that once seemed reliable, would plant the seeds of the next crisis. Because in the world of finance, the one constant is that nothing ever stays the same. Welcome to Part 2, Monetary Policy in the 21st Century. The global financial crisis, and the Great Recession. On a September morning in 2008, in the bustling streets of New York, something went silent. It was not the traffic. It was not the weather. It was a name: Lehman Brothers. After more than 150 years, one of Wall Street's largest investment banks had collapsed. The news spread like wildfire. Ordinary people turned on their televisions. Traders and bankers sat frozen before their screens. Lehman had filed for bankruptcy. In an instant, what once looked invincible became rubble. And that was only the beginning. At the center of it all stood Ben Bernanke, then chairman of the Federal Reserve. Bernanke was not just an economist, he was a storyteller of data, and above all, a scholar of the Great Depression of 1929. He had dedicated his career to understanding how to prevent such a disaster from happening again. Now fate had placed him in the very position to either repeat history, or rewrite it. Bernanke understood that what America faced was not just a financial crisis. It was a collapse of trust. The trust of depositors that banks would keep their money safe. The trust of businesses that credit would be available tomorrow. The trust of workers that their companies would still be open next month. And when that trust begins to crack, no balance sheet can save it. The chain reaction had begun with something that once looked harmless: subprime mortgages. People with unstable incomes were encouraged to borrow money to buy homes, sometimes without even proving they could afford them. Why did this absurd situation happen? Because the market believed that housing prices would always rise. If someone could not repay their loan, they could simply sell the house, and no one would lose. That was true, until everyone tried to sell at the same time, and prices began to fall. Then the dominoes collapsed. Banks had bundled these risky loans into complex investment products called securitizations. At first, these products were rated as safe. Credit rating agencies even stamped them with AAA ratings, as if they were untouchable. But inside those shiny packages were rotten loans. Day after day, the bad debts piled up. Panic spread among banks. Everyone hoarded cash. No one dared to lend to anyone else. The credit market, the lifeblood of the economy, began to freeze. Businesses could no longer roll over their funding. Companies failed to pay wages. Consumers stopped spending. The entire economy was like a runaway truck with no brakes on a steep mountain road. And the Fed had to step in. Ben Bernanke not only used traditional tools like cutting interest rates, he changed the rules of the game. He began injecting liquidity into the financial system on a scale never seen before. Hundreds of billions of dollars flowed out of the Fed, not only to support banks, but also insurance companies, securities firms, and even the mortgage markets, together with the U.S. Treasury. The Fed announced a sweeping $700 billion rescue program to recapitalize the largest financial institutions. At that moment, ordinary Americans began to ask, why was the Fed saving Wall Street while their homes were being foreclosed? The bitter but simple answer was, if Wall Street collapsed, everyone would collapse with it. Bernanke was not alone. He had a crucial partner, Treasury Secretary Henry Paulson. The two men, from very different worlds, worked side by side during the most breathless hours of the crisis. They met through sleepless nights. They called the heads of major banks. They lobbied Congress, faced the press, and most importantly, tried to keep America from falling into the abyss. But not everything went smoothly. One institution was not saved, a decision that Bernanke later admitted was regrettable. The reason: there was no legal framework to act at that time. Lehman Brothers was different from earlier cases, when the Fed could partner with J.P. Morgan to engineer a rescue. Lehman was left to fail, and the price was chaos across the markets. One by one, major institutions wavered. The giant insurer AIG stood on the edge of collapse, after guaranteeing too many toxic products. The Fed was forced to temporarily nationalize AIG, an unprecedented move. Next came Fannie Mae and Freddie Mac, two government-sponsored mortgage giants, which were also taken into federal control. Every action was urgent. Each day was a race against time. And in the midst of it all, the Fed launched a new strategy: quantitative easing. With interest rates already near zero, the Fed no longer had room to cut further. Instead, it printed money to purchase large-scale assets, treasury bonds and mortgage-backed securities. The goal: flood the markets with cash, push down long-term interest rates, and create the confidence that there was still a buyer. It was a gamble with no precedent. And that was how history was rewritten, not with bullets, but with Excel spreadsheets and 3 a.m. decisions. In 2009, as America struggled to rise from the wreckage of the financial earthquake, Bernanke sat in his Washington office, gazing out through the frosted window. He knew the battle against the financial crisis might have passed its peak, but the war against the Great Recession was only beginning. The Fed could not simply put out fires. They had to rebuild the financial house from its very foundation. Unemployment soared above 10%. Millions lost their jobs, their homes, and their faith. The crisis was no longer just about bank liquidity, it had become a social crisis. And as consumer and business confidence spiraled downward, traditional policies proved powerless. Bernanke and his colleagues understood that they could not just wait for the market to heal itself. As in past downturns, if the Fed did not act boldly, the economy could sink into years of stagnation, much like the 1930s. So they expanded the program of quantitative easing, first QE2, then QE3, pushing the Fed's balance sheet to levels unprecedented in modern history. Beyond that, the Fed pledged to keep interest rates near zero for an extended period. It was a clear signal: policy would not tighten until the recovery was real. This helped stabilize expectations and encouraged businesses to begin spending and investing again. But the Fed's actions did not escape fierce criticism. From Congress to academics, many accused Bernanke and the Fed of recklessly printing money, devaluing the dollar, and enriching Wall Street while Main Street still suffered. Bernanke responded with something few policymakers dared to use: history. In testimony before Congress, he emphasized that without bold action, America risked repeating the Great Depression of 1929, the very catastrophe he had devoted his life to studying. And this time, unlike the last century, the Fed chose action instead of standing idle. One of Bernanke's boldest moves was a campaign of strategic communication. No longer would the Fed operate in secrecy. Instead, he announced clear goals, such as keeping inflation at 2%, a target never before declared openly. The Fed began holding public press conferences, explaining policies, and building trust with transparency. No Fed chairman had ever spoken as much as Bernanke. But he believed that in times of crisis, transparency was itself a powerful form of monetary policy. Under his leadership, financial markets gradually stabilized, stock prices rose steadily, credit began to flow again. And businesses started hiring, and then came the unexpected: a recovery without inflation. Despite the Fed injecting trillions of dollars into the system, inflation did not surge as many had feared. Why? Because the economy still had excess capacity, high unemployment, idle factories, weak consumer demand. The Fed's money did not flow into goods, it flowed into assets, stocks, bonds, and real estate. This was why many called the post-2008 rebound a Wall Street recovery, not a recovery for ordinary workers. By 2013, as markets began to overheat, Bernanke delivered a shocking statement: the Fed would soon reduce its asset purchases, a move known as tapering. That single word shook global markets. Emerging economies like Brazil and India saw their currencies plunge as capital fled. The world had become dangerously dependent on Fed policy, and that gave Bernanke's every word a kind of soft power never before seen in a central banker. By the end of his term, he carefully managed the tapering process, avoiding a market shock. In 2014, he stepped down as Fed chair, leaving behind a lasting legacy. He was not only the man who helped America escape its worst financial crisis since the Great Depression, but also the thinker who reshaped how we understand the role of central banks in the 21st century. Bernanke proved that monetary policy was no longer a dry instrument, adjusted a few times a year. It had become a strategic weapon, capable of determining the survival of the economy and the confidence of millions. And so Part 2 closed with a truth for an age of uncertainty: a central bank cannot merely defend the currency. It must safeguard the heartbeat of society itself. Quantitative easing, QE1, QE2, and later QE3, were not just giant numbers on a balance sheet. They were a declaration to the markets: the Fed would do whatever it took to prevent financial collapse. Yet outside Wall Street, people still struggled, with unemployment, with foreclosures, with pensions evaporating as stock prices crashed. And then came a wave of anger. The Occupy Wall Street movement erupted. Thousands poured into the streets, camping in New York's financial district under banners that read, "We are the 99%. It was the voice of those who felt left behind while the richest 1% and the giant corporations received government support. Even the Fed, though a technical institution, was dragged into the storm of public criticism. Bernanke, the quiet scholar, now had to testify before Congress, explaining every dollar printed, every asset purchase signed. Yet what few noticed was this: central banks around the globe were following the Fed's lead. 31:37, the European Central Bank, the Bank of Japan, the Bank of England, all rolled out their own versions of QE. The world entered an unprecedented era, of record low interest rates and central bank balance sheets swelling to historic levels. In 2009, a new administration took office. President Obama and his economic team began pushing massive fiscal stimulus packages. Working hand in hand with the Fed's loose monetary policy, Bernanke, originally appointed by President Bush, was unexpectedly reappointed by Obama. A Republican economist kept in place by a Democratic president. A sign that the Fed's expertise and credibility had, at that moment, risen above partisan politics. By 2010, the U.S. economy began to show signs of recovery. The stock market climbed back, and unemployment slowly declined. But it was not an even recovery. The middle class, workers, and those who had lost their homes in the foreclosure wave still could not get back on their feet. The gap between rich and poor began to widen more sharply than ever. And just when things seemed to be stabilizing, the Fed faced a new challenge: inflation did not return. It sounded like a paradox. For decades, inflation had always been the nightmare. Yet in the 2010s, even after the Fed had pumped trillions of dollars into the financial system, prices did not rise as expected. Experts began to wonder, were we entering a new kind of stagnation, like Japan in the 1990s? Bernanke answered with policy. The Fed launched one of the most important shifts in modern monetary thinking, moving from strict inflation control to managing expectations. In practice, that meant instead of cooling the economy whenever inflation ticked up, the Fed would allow it to run above the 2% target for a short time, so long as it had stayed below target for an extended period beforehand. It was the Fed's way of sending a message: we are not only fighting inflation, we are also committed to creating jobs. A broader, more inclusive social promise than simply keeping prices stable. But not everyone agreed. Inside the Fed, some members, especially regional Fed presidents, grew uneasy. They feared that if inflation slipped out of control, market confidence would collapse. Heated debates erupted in FOMC meetings. Bernanke had to stand in the middle, maintaining market trust while calming internal doubts. At the same time, the Fed began reforming how it communicated. In the past, Fed chairs had often kept silent or spoken in vague riddles. But under Bernanke, the Fed started holding press conferences after each policy meeting. It was a revolutionary step, bringing transparency to central banking. Bernanke wanted the Fed to stop being a mysterious fortress and instead become an institution close to the public. He understood that confidence could not come from complex charts, but from transparency, commitment, and the ability to explain every action clearly. And then in 2013, Bernanke announced he would not seek another term. His legacy was not a perfect economy, but an economy that did not collapse in its darkest hour. More than that, he left behind a Fed that was stronger, more flexible, willing to learn, and ready to adapt to a constantly changing world. In the fall of 2013, at Princeton University, his old academic home, Bernanke stepped onto the stage to say farewell as Fed chair. He chose not to recite hollow victories or grand triumphs. Instead, he shared something deceptively simple: throughout the crisis, I did not sleep well for years. My fear was not about numbers, it was about people. Millions could lose their jobs, their homes, their future. Those were not the words of an economic deity. They were the words of a man carrying the burden of saving trust, the most fragile asset in any economy. His successor, Janet Yellen, was a seasoned economist and the first woman ever to serve as chair of the Federal Reserve. She continued Bernanke's recovery policies but faced a new challenge: how to withdraw emergency support without triggering panic in the markets. How to raise interest rates again without choking off the fragile recovery. This was the puzzle of the post-crisis era, the normalization of monetary policy. The Fed began cautiously, shrinking its balance sheet little by little. Instead of dumping assets, it simply allowed them to mature naturally. At the same time, Yellen and the FOMC laid out a roadmap to gradually raise interest rates. Every announcement was carefully prepared and clearly communicated. The goal was to leave no room for surprises, avoiding a repeat of the taper tantrum that had shaken markets back in 2013 when Bernanke hinted at cutting QE. But the world did not stand still. China began to slow down. Oil prices collapsed. Europe struggled with a sovereign debt crisis, from Greece to Italy, from Portugal to Spain. The European Central Bank and other major central banks continued aggressive monetary easing. Meanwhile, in the US, under President Trump, a bold tax policy boosted short-term growth but raised concerns of widening deficits. The Fed now found itself caught between a chaotic world and a domestic economy that was still not fully healed. Every step had to be calculated with care. Raising interest rates too quickly could tip markets into recession. Moving too slowly could inflate dangerous bubbles. And then inflation returned, not as the monster of the 1970s, but as a strange enigma. Prices stubbornly refused to rise as predicted. Unemployment had fallen to historic lows, yet inflation remained sluggish. That was when the Fed realized something fundamental was changing in the way inflation worked. Economists began to dissect the problem. Had globalization reshaped the structure of prices? Had technology, Amazon, automation, suppressed wages and goods costs? Had inflation expectations become frozen after years of the Fed's success in keeping prices stable? Under Jerome Powell, who succeeded Yellen, the Fed continued its mission of restoring order. But then, a new tidal wave appeared. This time, it didn't come from Wall Street, but from a virus. In 2020, the COVID-19 pandemic spread across the globe. Economies froze. Millions lost their jobs within weeks. Financial markets went into freefall. And once again, the Fed stood at the center of the rescue. Without hesitation, Powell and his team reactivated the full arsenal that Bernanke had deployed in 2008, this time even more aggressively. Interest rates were slashed back to zero. QE was relaunched on a multi-trillion-dollar scale, larger than ever before. For the first time, the Fed even bought corporate bonds, providing liquidity directly to companies on the brink of collapse from the pandemic. More importantly, the Fed introduced a groundbreaking shift in thinking. an average inflation target. Instead of strictly keeping inflation below 2%, the Fed would now allow it to run above target for a period, to compensate for years when it had been too low. This was more than a technical change, it was a message to workers. The Fed promised not only to maintain price stability, but to build a labor market that was sustainable and inclusive. A more social Fed, though still fiercely independent. And then, as if history were repeating itself, inflation did return, for real. By late 2021 and early 2022, prices of commodities, energy, and housing surged, partly due to supply chain disruptions. Partly because demand rebounded so quickly after the pandemic, and partly as a direct consequence of the massive rescue packages launched in the 2 years before. The Fed, which had kept interest rates near zero for almost 2 years, was now forced to pivot. In 2022 and 2023, it raised rates at a pace not seen since the Volcker era. But this time, the Fed wasn't fighting old-style inflation. It was confronting an economy deeply addicted to cheap credit. Each rate hike landed like a blow, on the housing market, on small businesses, on indebted consumers. Yet Powell knew the Fed could not hesitate, for the lesson of the 1970s still loomed large: once inflation seeps into expectations, it becomes an economic cancer. Part 3: Monetary Policy in the 21st Century, from takeoff to the COVID-19 pandemic. On a May morning in 2009, as the New York Stock Exchange opened under the pale spring sunlight, perhaps no one realized that this was the true bottom of the modern Great Recession. Just months earlier, trillions of dollars had been wiped from markets, banks had failed, companies had shuttered, and millions had lost their jobs. Yet in those darkest hours, a faint lifeline quietly began to return. Like a fragile light flickering at the end of a tunnel, monetary policy became the torch that guided the way. The U.S. economy began a strange kind of takeoff after the financial crisis. Strange, because it was quiet. There was no dot-com boom, no housing bubble, no double-digit growth, no stock frenzy, but quarter after quarter, year after year, unemployment numbers gradually fell, interest rates stayed at record lows, and the Fed remained quietly at the helm. Janet Yellen, who chaired the Fed from 2014 to 2018, was the first woman ever to hold the position. She was not only a brilliant economist, but also deeply attuned to the labor market. To her, each percentage point of unemployment was not just a statistic, it was millions of lives. Families. Empty dinner tables. Yellen led the Fed with a soft heart but firm resolve. She kept interest rates low. She allowed the job market to recover to its deepest levels. This was the period when the Fed shifted, from being a crisis firefighter to becoming the guardian of recovery, but the stronger the recovery, the bigger the questions. When should normalization begin? When should money printing stop, rates rise, and could it even be done at all? The economy was being sustained by stimulus. The financial world called it the new normal: low growth, low inflation, low interest rates. For the first time in its history, the Fed had to learn how to live with persistently low inflation. In the past, inflation had been the eternal enemy. But now, the Fed was trying to push it higher. To do that, a new strategy was born: widening future expectations. The Fed would not only manage current policy, but also signal its intentions for the future. We will keep interest rates low until unemployment falls below X%, or inflation reaches at least Y%. This strategy was like a boatman calling out, "Don't worry, the river ahead has no hidden rocks, just keep rowing." And indeed, it worked. Markets calmed. Businesses regained confidence. Investments gradually returned. In this same period, a quiet but strategic shift took place. The Fed redefined its understanding of full employment. In the past, whenever unemployment dropped too low, the Fed feared inflation and raised interest rates. But between 2015 and 2019, unemployment steadily fell below 4%, while inflation barely moved. This forced the Fed to ask, could the labor market absorb more? Were there groups, such as minorities, workers without degrees, or those historically left out of full employment, that could still benefit? The Fed began to change. It no longer focused only on headline numbers, but looked deeper into vulnerable groups in the labor force. Monetary policy started to take on a more social, more human dimension, something no previous generation of central bankers had attempted. By the time Jerome Powell became chair in 2018, the Fed had evolved into a flexible, transparent institution, an indispensable player in the global economy. But a new challenge was approaching. And this time, it did not come in the shape of a financial crisis or an investment bubble. It came in the form of an invisible virus. In May 2020, Wall Street, the world's most vibrant financial center, fell eerily silent. Trading screens flashed red. In just 1 week, the Dow Jones plunged more than 10,000 points, not because of debt defaults. Not because banks were collapsing. But because of an invisible enemy sweeping across the globe, SARS-CoV-2, better known as the coronavirus. For the first time in modern history, the global economy froze, not because of war or financial collapse, but because of health. Flights were cancelled en masse. Supply chains snapped. Factories shut down. Millions of people were forced to stay home. And in this unprecedented earthquake, the Fed was once again called upon. Powell, the Fed chair, had no time to hesitate. Within weeks, he and his colleagues took historic action, cutting interest rates to nearly zero, pushing borrowing costs to their lowest point, just to give businesses a little oxygen to survive. They relaunched quantitative easing, buying trillions of dollars of government bonds and mortgage-backed securities, pumping liquidity into the system. Most importantly, they broke traditional boundaries of what a central bank could do. The Fed began buying corporate bonds, directly supporting credit funds, and even creating special lending programs for small and medium-sized businesses. In the past, such moves would have been seen as heavy-handed intervention, or even illegal. But in the pandemic, the Fed became the last heartbeat of the economy. And it did not act alone. The U.S. government, under President Trump and later President Biden, rolled out massive fiscal rescue packages, from the Paycheck Protection Program, PPP, for small businesses, to direct payments of thousands of dollars to individual citizens. The total scale of rescue packages exceeded $5 trillion, an amount never seen before in economic history. Yet, no one knew for sure what would come next. Many economists warned that pumping in so much money would spark inflation. But in reality, things were different. People weren't spending. They saved. They waited. Consumer confidence fell to a record low. The labor market evaporated, more than 20 million jobs lost in just a single month. The Fed and the government were forced into an unprecedented balancing act, saving the economy without making it addicted to stimulus. And then, a miracle arrived in 2021. With vaccines deployed on a massive scale, the economy began to recover at an astonishing pace. Unemployment fell faster than expected, the stock market soared. Industries once thought to be in a coma, tourism, restaurants, retail, came roaring back to life. It was something never seen before, the deepest recession rebounding into the fastest recovery, powered by the twin engines of monetary and fiscal medicine. But every success comes with consequences. As demand surged after the pandemic, while supply struggled to catch up, prices began to rise: gasoline, beef, rents, even used cars. And then, a word long forgotten from the headlines returned: inflation. At first, the Fed and the Treasury called it temporary inflation. They argued it was caused by supply chain shocks, containers stuck at ports, chip shortages, or a sudden surge in shipping costs. But as time passed, inflation didn't fade. It climbed higher, 6%, then 7%, and above 8% by mid-2022, the highest in 40 years. This was when the Fed faced its toughest challenge of the 21st century: how to tame inflation without killing the recovery. The answer: act quickly, decisively, and without fear of pain. Jerome Powell and the FOMC launched the fastest rate hike cycle since the days of Paul Volcker. From near zero, interest rates shot up to over 5% in just a little more than a year. The shock was like slamming the brakes on a highway. The housing market stalled. Businesses struggled to borrow. Stock prices corrected. But at the same time, inflation slowly cooled, falling below 4%, then edging closer to the 2% target. In parallel, the Fed also began shrinking its balance sheet, reducing the vast assets it had bought during the crisis. This was a necessary step to detox the financial system and return the economy to a state of self-sustaining growth, without artificial stimulus. By late 2023, as inflation cooled, the Fed faced a question bigger than monetary policy itself: had confidence truly returned? Not just confidence in interest rates or balance sheets, but in the ability of an independent institution to guide monetary policy in an unstable world. For since the pandemic, the world had entered a new era, one where shocks were no longer exceptions, but the norm. In just a few years, policymakers had to confront a pandemic, supply chain crises, geopolitical conflicts, and the threat of global economic fragmentation. In this new world, the Fed could no longer rely solely on traditional tools. A fundamental shift began to take place. The Fed moved from simply reacting to data, to guiding social expectations. This was reflected in how it approached the job market, income inequality, and even climate change. Yes, that's right, for the first time in history, the Fed began discussing climate risk as a financial factor. They did not directly set carbon prices, but they analyzed the impact of climate change on financial stability, on credit structures, and on the repayment capacity of businesses. Monetary policy in the 21st century was no longer just about printing money or adjusting interest rates. It was about shaping a future where risks are interconnected and public expectations are multidimensional. Jerome Powell once said in a speech, "Trust in the Fed does not come from us being right all the time. It comes from being transparent when we are wrong, and decisive when action is needed." That statement captured the modern essence of monetary policy. It was no longer a technical black box, but a story about responsibility, trust, and adaptability. Meanwhile, a new generation of young economists was rising. They questioned the Fed's role in addressing income inequality. They asked whether low interest rates had unintentionally pushed up asset prices, making the rich richer, while leaving the poor with nothing to invest. They debated central bank digital currencies, or CBDCs, a model that could completely transform how people access money and make payments. The Fed could not remain on the sidelines. It began researching, experimenting, and cooperating with global institutions to better understand how money would function in the digital age. At the same time, the Fed faced increasing political pressure. Congress paid closer attention to the central bank's decisions. Social advocacy groups demanded greater transparency and stronger social responsibility. The Fed's independence, once seen as untouchable, had become a frontline that had to be defended through real effectiveness and credibility. By the year 2025, monetary policy in the 21st century was no longer just an economic equation, it had become the art of balancing risk and responsibility. Data and perception, markets and people. It required not only skilled economists, but also great storytellers. people who could explain to ordinary citizens why interest rates were raised by just 0.25% today. It required not only accurate forecasting models, but also deep understanding of social psychology. Because every monetary decision could impact millions of lives. Above all, it required an institution that knew when to act, when to leave the market, and when to stand back. Part 1 closes with a simple declaration: monetary policy is not just a tool for managing liquidity. It is a mirror reflecting how a society confronts risk, injustice, and Part 4 begins: monetary policy in the 21st century, what lies ahead? January 2025. Snow blankets the rooftops of Washington. But inside the Federal Reserve, the meetings remain tense, tight as a drawn string. The world has moved past the pandemic, overcome the highest inflation in 4 decades. And now faces an entirely new age of uncertainty, not the old crises, but a future with no map. Monetary policy was once the art of managing cycles, raising interest rates when the economy overheated, and lowering them when recession arrived, but now, the old cycles are broken. The rules we once knew seem to no longer apply. So, what lies ahead? In the first 3 parts of this book, readers have seen how the Fed, under chairmen like Volcker, Greenspan, Bernanke, and Powell, responded to crises. In this part, Bernanke takes us to a broader, deeper picture, the fundamental challenges that 21st century monetary policy must face in the coming decade. The first challenge is the persistence of low natural interest rates. In the years after the 2008 financial crisis, and again after the COVID-19 pandemic, central banks had to operate in an environment where real interest rates, adjusted for inflation, were lower than at any other time in history. The cause was not only policy, but deeper structural forces: aging populations, slower productivity growth, and global savings exceeding investment. Low interest rates limited the power of monetary policy. When crises struck, there was little room left to cut rates further. The Fed was forced to use unconventional tools such as quantitative easing and forward guidance. But all of these had limits. The second challenge is financial instability, and the Fed's role in supervising the system. In the past, the Fed focused on its dual mandate: maximum employment and stable prices. But recent crises, from the dot-com bubble, to the housing collapse, to turmoil in cryptocurrency markets, raised a hard question: should the Fed play a more active role in monitoring and preventing financial risks? Bernanke suggested that financial stability must become a third objective of monetary policy, not by doing everything, but by better coordination between monetary tools and supervisory tools. The third story in this part is digital money and the future of currency. When Bitcoin appeared in 2009, many dismissed it as just a tech fad. But today, the decentralized finance ecosystem, DeFi, and digital assets have grown into a parallel reality alongside the traditional financial system. Central banks, including the Fed, cannot remain outside. Bernanke posed a critical question. Do we need a central bank digital currency, a CBDC? A digital dollar could make payments faster, more transparent, and more inclusive. But it could also bring new risks: privacy concerns, the danger of mass withdrawals, and a shift in the balance of power between the central bank and commercial banks. The issue is not just technology, it is design. How do we create a digital currency that serves the public good without destabilizing the financial system? Alongside this is a more philosophical question: if technology can replace every intermediary, do we still need a central bank at all? Bernanke does not answer directly, he leaves it open, like an invitation for readers to think along. In a decentralized world, the Fed is no longer the absolute controller. It must become a connector, a navigator, more of a commander within a network, rather than a central authority issuing orders. The next challenge Bernanke highlights in part 4, and perhaps one of the energy transition, climate has become a crucial financial variable. As Bernanke explains, the Fed does not directly design environmental policies. But it does have a responsibility to understand and integrate climate risks into the financial system. A bank issuing mortgages in coastal Florida must take rising sea levels into account as a credit risk. A manufacturing company reliant on coal may face higher capital costs if the green finance trend continues. This is where new tools like climate stress tests come into play. The Fed, along with other central banks, now run simulations, such as global temperatures rising by 2.5 degrees Celsius by 2050, and measures how such scenarios would affect the balance sheets of the banking system. Yet Bernanke stresses that a line must be respected. The Fed must remain politically neutral, even when addressing climate issues. That means the Fed cannot decide on its own what counts as green. But it can help markets properly price climate risks. This implies a more sophisticated, more complex role, one the Fed cannot avoid. Another global challenge is geopolitical instability. The world is fragmenting under trade wars, technological competition, and even military conflict. The financial system cannot remain immune. Bernanke points to the energy shock caused by the Russia-Ukraine war, which drove European inflation sharply higher, forcing the European Central Bank to tighten policy even as its economy had not yet recovered from the pandemic. The Fed, though not directly hit, must still make decisions in a global environment full of spillover risks. Markets no longer react in isolation. A policy move by the Bank of Japan can instantly redirect capital flows into U.S. Treasury bonds. A crisis in a developing region can trigger a worldwide sell-off in risky assets. Monetary policy today is not just a domestic mission, it is a voyage across stormy international seas. Within America itself, there is a deeper challenge: inequality. Bernanke openly admits that monetary policy, while fostering growth and controlling inflation, can also widen the gap between rich and poor. When the Fed keeps interest rates low to stimulate the economy, asset prices, stocks and real estate, rise sharply. But the main beneficiaries are those who already own assets. Wage earners without significant savings benefit much less. The Fed cannot solve inequality on its own, but it can, and should, take into account the distributional impact of its policies. For example, when deciding to raise interest rates quickly to fight inflation, the Fed must consider who will be hit the hardest: homebuyers, small businesses, or low-income communities. This is where the idea of inclusive monetary policy comes in. It does not mean favoritism. It means policies informed by social awareness. The Fed has begun collecting more detailed data, analyzing minority groups, listening to small businesses, and expanding dialogue with civil society.